Let's talk about something that separates successful traders from everyone else: risk management. It's your safety net in the high stakes world of crypto trading. Without it, even the smartest strategies can crumble. And the good news? You don't need complex tools or a finance degree to master it. Let's explore how to protect your portfolio and stay in the game. I'm not a financial advisor. Why risk management matters. Risk management is your defense against crypto's notorious volatility. Imagine this: Bitcoin drops by $3,000 in an hour and your portfolio takes a hit. Now imagine you set clear limits on what you're willing to lose. Instead of panicking, you're calm. You know that a single trade won't derail your long-term goals. That's the power of risk management. It's not just about protecting capital. A solid risk strategy keeps emotions in check. Think about how fear or greed creeps in when the market gets wild. Having a plan in place helps you stick to your strategy, no matter how chaotic things get around you. Foundations of risk management. Let's start with the basics. Before you place a trade, ask yourself, how much am I willing to lose? For many traders, the golden rule is risking no more than 1 to 2% of their portfolio per trade. If you got $10,000, that means risking $100 to $200 per position. It's simple math that ensures no single loss can wipe you out. Next, there's the safety net, stop loss orders. Picture this: you buy Bitcoin at $94,000, expecting a rise, but just in case it dips, you set a stop loss at $92,500. If the price falls, your position automatically closes, capping your loss. No second guessing, no panic selling, just disciplined trading. Diversification is another key. Think of your portfolio as a dinner plate. You wouldn't pile it high with just one food. Similarly, don't invest everything in a single coin. Balance stable giants like Bitcoin and Ethereum with more speculative assets. That way, one bad trade won't ruin the whole meal. And what about leverage? It's tempting to borrow big for potentially huge gains, but high leverage is a double-edged sword. It amplifies wins. Sure, I've had a lot of those, but it magnifies the losses too, and I've experienced plenty of those in my career. Use it sparingly though, and only when you're confident in your analysis. How to manage risk like a pro. Here's how seasoned traders approach risk. They start by calculating position size. Let's say you're willing to risk $200 and your stop loss is set $1,000 below the entry price. Divide $200 by $1,000 and you'll see you should invest no more than 0.2 Bitcoin in this trade. It's a small step that makes a big difference. Then they look at the bigger picture, risk-reward ratios. Imagine risking $1 to make $3. That's a 3 to 1, meaning your wins will outweigh your losses over time. If a trade doesn't meet this threshold, they skip it. It's about quality over quantity. In journaling, that's another powerful tool. Successful traders, they keep a log of every trade, noting what worked and what didn't and why. Over time, this habit reveals patterns and helps fine-tune strategies. It's like having a personal roadmap to better decisions, avoiding common pitfalls. Let's face it, every trader makes mistakes, but the pros, they learn from them. They know better than to chase trades out of FOMO. They've seen how doubling down on losing positions, well, it usually leads to bigger losses. And they never ignore their stop losses, no matter how tempting it is to wait and see. That's right, mission's accomplished. What did we learn in this mission? Well, we learned risk management isn't just a box to check. It's your lifeline in the unpredictable world of crypto trading. By knowing your limits, setting your safeguards, and sticking to a plan, you'll trade with confidence and you'll stay in the game for the long haul. At the Bitboy BootCamp, we're here to help you master these essentials. Start today and turn risk management into your greatest trading asset. 10-4, Bitboy out.